In today's presentation, I want to take you through the quarterly review of Lunar Capital's investments and our performance in our various products. So, as is usual, we start with our disclosures. It's important for you to understand that, and you can take the time to read that when you get a chance. So let's start with 8 years on. We're still going strong. And if you look across the 8 years, we've had consistently very good performance across all periods. A slight dip in the 3-year period, but really at the end of the day, a top quartile performer in all but the 3-year period in the Lunar BCI Worldwide Flexible Fund across the Worldwide Flexible Fund category. And then importantly, when we look back and we looked at all of the funds that were available in South Africa at that particular point in time, Lunar Capital or the Lunar BCI Worldwide Flexible Fund is a top 12% performer. So really, very good performance across the period. And then lastly, I just want to say that, our aim has always been, to provide, above inflation levels of returns for our investors. And I think we have achieved that across all of the periods, and certainly, in most of the periods beating the benchmark, of 5% plus South African inflation. So thank you to our clients that have put their faith in us, across these various periods. If we compare ourselves across the 1 year, the JSE actually has done quite well, over this period, giving a 19.5% return. The S&P 500 has been really on an absolute tear, 34%, and the MSCI World, all company worldwide index, gave a 27.8% return. So really pretty good. To some extent, the performance on the Lunar BCI Worldwide Flexible Fund was offset because of the strength in the rand against the dollar, and that provided actually a strength of almost 9%. Giving the Lunar BCI Worldwide Flexible Fund a 19% return. But we also positioned ourselves in this last quarter to be a little bit more conservative, taking some profits, especially in those companies that have run very, very well, and that has obviously, dragged our performance a little bit. But to be honest, 19% return is still a pretty good return. So, how do we achieve this, right? I mean, at the end of the day, we have maintained that we have a consistent policy and a philosophy about how we invest. Okay, so we think of ourselves as owners of quality businesses with high growth potential and that have significant competitive advantages. Now, when you think of yourself as an owner of a business, you're not really a trader. You're not in and out of stocks. So we don't really trade. And actually, this presentation, you will find that there's a level of consistency, across the periods where there's very, very few changes that we make in the portfolio. Obviously, we will make changes as opportunities come, and certainly as we find, that a particular company has now basically run, its course, we will make those changes, but those will really be few and far between. Now, the philosophy that we follow basically looks at, a process that we have developed and honed over time, and we continue to hone that, but really the core of it is still fundamentally the same. We try to identify some mega trends that are taking place in the world at this particular point in time, and those mega trends, will provide us with ideas of where we can invest. So we look for those companies that can have those, that can have the benefit of those mega trends, behind them. And then we basically do an evaluation of those companies, and we select those companies, to be invested in. We do provide an overlay based on just guidelines on, we don't want to be overexposed to particular sectors. We certainly also don't want to be, too highly exposed in the equity market, if we think that valuations are high, and also if there are opportunities, in one jurisdiction versus another, for example, South Africa versus, the US, then certainly, we would try to overlay that, right? But the core concept, of the mega trends that are there, the companies that we want to be invested in, actually the companies that we want to be owning, okay, we have that, in the portfolio. And that's eventually how we come up, with our portfolio construction and take that through time. So some of, the major trends that we're seeing at the moment, and that we're looking out for, right, is interest rates, inflation, and energy. And we've seen, for example, that inflation has started coming down, finally, particularly in the US, Europe, certainly in South Africa as well. And that has basically allowed central bankers to start lowering interest rates. The US, for example, went for a 50 basis point decrease in interest rates. South Africa, went with on a 25 basis points. In other words, a quarter percentage, a decrease in in interest rates. Now that basically, allows more money, in the pockets of consumers and businesses. And when that happens, it does allow the economy to start picking up. So we think that generally that is quite good. We still think that interest rates are still probably too high, but at the same time, we don't think that inflation will just go away suddenly and not maybe even rear its ugly head in the future. So we do ask ourselves, how quickly, will these interest rates go down? And we are basically positioned, for a little bit slower rather than faster. Then the other thing that drives inflation as well is, or one of the fundamental factors of driving inflation is the price of oil, okay, which is basically the fuel, of every economy out there. So with the conflict in the Middle East, you have seen, for example, in the last few weeks, a big rise in the oil price, and that obviously could potentially have a negative impact, on inflation. And then the last thing from an energy point of view, with this demand for AI, and the servers that run these AI programs, effectively that is going to require a lot of energy. And what we're starting to see is that many companies are starting to look at potentially tying up with nuclear power stations that may have been mothballed or are running at a slightly lower rate, and allowing those to basically fuel some of these data centers that are going to be running these AI machines. So we're starting to see some of that starting to take place as well, and that is allowing us to start thinking about whether we should be invested in the nuclear space as well. And that's something that we will certainly give you a better feedback on in our next quarter. From a technology point of view, we see AI continuing to drive growth in the technology sector, and we also starting to see many companies starting to look at opportunities, for example, in how they can use AI to improve productivity. For example, in software development, using agents for medical treatments, in the genetic space, in analysis, etc. So we're starting to see those are some of the things that that will come to the fore, right? So that's something that we're looking out for and seeing where we should be invested in. In fact, we've invested in some of these already. From a biotech point of view, certainly, the trend that we picked up, fairly early on around weight loss and diabetes, we still think that demand is still high for that. And many of these companies like Eli Lilly and Novo Nordisk have started basically ramping up their production capacity to be able to deal with this demand. So we really see that continuing to be a trend, and continuing to fuel, growth in those businesses. From a generational point of view, Generation Z and millennials now make up the largest part of the workforce. Okay, and interestingly, so that means that's where the spending is going to be coming from. And that's what's going to drive how businesses are being run, etc. So we're really looking at that and saying, how can we benefit, from that? And the other interesting thing is that, as boomers are getting to basically retirement or even kind of, dying, you're seeing a lot of inheritance, from boomers into, the Gen Z generation, and we're starting to see some of that, taking place as well. So we see Gen Z and millennials to be actually a very, very interesting and important part of, how the future will play out. From a geopolitical point of view, there's a lot going on there at the moment, and it's really in some ways a bit of a dangerous time in the world. Elections, it could potentially affect it, but we've been through, over the 8 years, we've been through a Donald Trump presidency, we've been through Brexit, we've been through many of these things, right? And at the end of the day, you can see from the performance of the funds that these things really just, you have that blip at the particular point in time, but over time, we get through that. And lastly, around South Africa, really very positive, in our country at the moment, and we've certainly seen wonderful opportunities for us to be invested in the South African market as well. So quickly, just to run the top 10 holdings in the Lunar BCI Worldwide Flexible Fund, Berkshire Hathaway. You guys know that. Maybe more importantly, I wanted to talk about our positioning on taking a bit of a stake in the Vanguard short-term Treasury ETF, and the reason for that was we felt that the markets have been a bit high, so we took a bit of a conservative stance, to park some money away, waiting for opportunities where there's better valuations, and we can start investing in that. But the colors also represent, for example, the different sectors that you are involved in. So you can see, asset allocators like Berkshire Hathaway and Coronation Asset Management, retailers like ShopRite and Walmart, a bank like First Rand and JP Morgan. It's not on this list, but we have invested in that. Pharmaceuticals, Eli Lilly and Novo Nordisk. So you see, and technology, of course, a big part of where we invest in ASML and Nvidia. So that's what we've seen. Also a nice balance between South Africa, and offshore. And it's very similar, for example, in the offshore portfolio. We have very, very similar companies. There might be a few more that we are invested in there because we have the opportunity to invest, for example, in markets outside of the US in that environment. So companies like Adyen, which is a fintech business, we are invested in. A company like LVMH, which is Louis Vuitton, Moët Hennessy, a large luxury goods manufacturer. So we have those businesses in our portfolio as well in the offshore side. Okay. So really, that's really a synopsis of our business performance. We think we've still got an absolutely decent track record. We don't rest on our laurels. We don't think that past performance is an indication of what future performance would be. But certainly, because we have skin in the game, and we look after this like it's our own money, and obviously, I mean, the responsibility that we have of looking after your money, we will continue to look at the portfolios and try and invest the best way possible to get absolutely the kind of decent returns that we have seen in the past, and we hope to continue to see in the future. The two products that we've got, the Lunar BCI Worldwide Flexible Fund, still open for investments, and the offshore portfolio, investments as well, is open for us. Contact details are there, and thank you very much for the opportunity to present to you. Thank you.